Joining us now is Pramod Gubbi, Managing Director, Head of Institutional Equities at Ambit Capital, who's joining us on the show now. Hi, sir. Good morning to you, and thanks a lot for joining us today on Bloomberg Quint. What's been the reading overall for the markets, which have been weak? Is it the macros deteriorating? Is it the uncertainty around the Karnataka election results, or the earnings growth have not been with what the street was estimating this time around?
I think it's a mix of pretty much everything. There's a lot going on globally as well on the geopolitical front, be it the trade wars or the negotiations around the oil-producing nations and Korea. At the same time, we've had a bit of a seesaw in terms of the results of the Karnataka election. While on the one side you have some sense that political stability might remain given the continued support for the ruling party. There have been concerns arising about the potential for all the opposition parties to unite and put up a strong front. And finally, yes, I guess what we expected to be a pretty strong earnings season hasn't turned out to be particularly strong given the impact of commodity prices and the resulting margin declines we've seen in several stocks. So I guess each of it has had its own contribution to the sort of volatility in the markets.
Hey, Pramod, good morning, Neeraj here. Does all that's happening around, I mean, politics notwithstanding, I'm just talking about what's happening on the global front as well, worry you about an imminent crash of sorts? Yields where they are, crude prices where they are, at some point of time they'll pinch the US consumer and that can impact the mother market too. Does all of this worry you at all?
Oh yes, certainly. I think the macro has certainly deteriorated, particularly as far as India is concerned. I think even globally we're perhaps headed towards the end of the expansion cycle. At some stage, the Fed will step in, interest rates will put an end to the expansion, or at least curtail that expansion. Inflation will start looking up the way commodity prices are going up. And we've already seen the treasury yields move up at 3%. I guess if you're an asset allocator sitting in the US, you will be re-looking at some of your strategies and ask yourself, why do I have to take that risk, putting that incremental dollar in emerging markets? And at some stage that money will go back to the US. The dollar strengthening just adds a bit of icing to that cake, if you can look at it that way, which makes it that much harder for emerging market asset classes in general. So I don't know about a crash, but yeah, certainly a lot of signs to worry about, which is why I guess this market is moving from a macro-driven, all boats get lifted by the tide, to a more bottom-up, earnings visibility-driven market, which augurs well for the bottom-up investor, by the way.
Where do you find comfort then, Pramod, in a market like this? It's a given that volatility will be rife, not domestically, even globally for 2018. Where do you deploy your money then?
I mean, ideally, you'd like to look at some margin of safety in terms of valuation, but unfortunately, there is none, at least in the Indian market. So, a year ago, we could have looked at IT, but that's run up as well. But having said that, I think the next comfort you should look for is earnings visibility. And I guess the three areas that you could look at is broadly getting a sense where you have some sort of immunity from these macro headwinds, particularly inflation rising, commodity cycle picking up. You would want to look at companies which have a strong pricing power, who can pass on the impact of those commodity inflation and retain their margins and continue to grow. Consumer particularly is a sector which lends itself with a lot of companies which have such strong brands. Alongside that, it has some tailwind in the form of growth as well, given we are in an election year with a significant spending related to the elections, but also the government is likely to pump in a lot of money through development spend, particularly in rural areas. So rural consumption with companies with strong brands is one theme. The second is, I guess, the private sector financials. Again, the state of the public sector banks means that you have a longer growth runway, but also the interest rate hikes mean that those banks with strong CASA are able to increase their margins, increase their spreads, and show disproportionate earnings growth. So that's another zone of comfort. while valuations aren't particularly attractive here as well, but I think the earnings visibility should give you some comfort. And finally, I think IT perhaps, it has reached a stage where global IT spend is picking up. Indian IT companies' investments in digital are paying off in terms of their ability to compete and take market share. And finally, you have a huge tailwind in the form of the rupee depreciating. So perhaps these three buckets are where you can derive comfort from, given the concerns around the macro.
Pramod, you spoke about rural consumption, and when we talk about that space, FMCG features right there on top. And so far, the earnings that we've seen from the companies like HUL or be it Dabur, Nestle, good set of numbers, good volume growth. But once again, the valuations, as usual, historically from this pack has been sky high. Should somebody take a fresh bet in the consumption space on the defensive side, keeping in mind once again that volatility could be on the higher side, so it's best to play on the defensive side?
Yeah, I think so. I think these companies are strong companies with strong brands, and like I said, at a time when you have a commodity cycle playing the way it is, you need to hide in companies which have that pricing power to be able to withstand that inflation. And alongside that, the demand, generally, even from a long-term perspective, is by and large stable. But here we are at a time where you have seen demand picking up and perhaps likely to stay that way over the next 12 to 15 months as they run up to the general elections. So you have pretty much all the boxes being ticked except for valuation. I think valuation for this sector and some of the other sectors which have demonstrated stable earnings growth has always moved up and up as far as the Indian market is concerned, unless and until we see a pickup in the investment cycle which can expand the sort of available investment opportunities for the investor. I guess these will continue to command a premium valuation. So I'm not saying that you might see benefits of a re-rating, but you can get some benefit of a stable but predictable earnings growth.
Pramod, my final question. By and large, the NBFC space this quarter around seems to have done extremely well. I can't think of a single NBFC which has come out with a very disappointing set of numbers. What have you made of that this quarter? And what's the pecking order? I'm not asking for a recommendation right now, but from the Ambit side, what's the pecking order? I mean, do you guys like the consumer-facing NBFCs like Bajaj Finance, or are you going for the SFBs like Equitas, Ujjivan? What is it that you guys like the most?
I think ultimately, like I said, this is going to be a period of rising interest rates. So you will have to focus on NBFCs which have a reasonably strong liability franchise, or at least a strong asset franchise where you have the pricing power to pass on the increase in the cost of funds. So to that extent, there are a handful of NBFCs, particularly in the auto financing space, which lend themselves to this dynamic, and that would certainly be our right up our pecking order. At the bottom of our pecking order are the ones which are totally in commoditized space, particularly prime mortgages, or rather high-end or urban housing finance companies, which are entirely have actually benefited by the drop in cost of funds in the bond markets over the last 3-4 years. And as you see that market, the cost of funding rising, while assets are being competed by some of the large, both public and private sector banks with strong CASA, there isn't much pricing power. So you can see a period where spreads are going to crunch, and you will see declining earnings growth coming through. We're not even talking about credit costs here. It's simple crunching of margins as the bond markets spike in terms of the yields there. So I'd say anywhere between the consumer-facing auto financiers on one end and the housing finance companies on the other hand would form a spectrum of companies in NBFCs.
Okay, Nifty slipped below the mark of 10,650 as well. It's down almost 40 points, and Bank Nifty is nearing the 25,900 mark. So the selling pressure definitely intensifies from the opening levels that we've seen, and both these indices have been seeing a downward trajectory, at least in the last two trading sessions. Pramod, if I were to look at the markets in 2018, the broader markets are the one which have seen a sharp reaction. Mid-cap and the small-cap indices now are down between 10 to 12%. Do you foresee more correction for the broader markets?
It is quite possible. Like I said, I wouldn't want to paint all the stocks in the broader market with the same brush, but the theme is going to be one about companies that are able to withstand this sort of a commodity inflation. And often in the small and mid cap space, like I said, there are exceptions to this rule, but often you will find companies which are me too in the space, which don't have that sort of a bargaining power with the customer to be able to pass on the impact of inflation, and hence you're likely to see more impact on their fundamentals in terms of margin declines and earnings growth slowing down, and hence as a result that bucket as a whole you would expect to take a further beating if commodity prices continue to stay where they are.
Okay, let's wait and watch how the markets react in the coming months. But Pramod, we leave it at that note. Appreciate you joining us today on Bloomberg Quint and taking through your views on the markets.